Okay, we're going to start today by looking at the S&P 500 chart, the SPY. You can see last week at this time, we we had an oversold condition. You can see we went the whole way down to oversold in our stochastics, and we went below the 20-day exponential moving average. And that 20-day exponential moving average has held since the April lows. But it seems like this week we bounced above that with some good earnings reports, and we're going from oversold, and we're about halfway between oversold and overbought. So we're again in nowhere's land. If we look at our chart, you can see that in the blue line right here, we we were basically in an uptrend. If you map out the lows and the higher lows, the higher highs, we had this chart that broke right here. It seems like we're in a new pattern here. We're going sideways. And that kind of corresponds to seasonality wise. You can see this Ian McMillan. He noted that the S&P seasonality for the month of August, September, October is kind of sideways. So it seems like we're following this seasonality um, so far this year almost perfectly. And you can see that towards the end of the year, we're going to have a good time. So just be prepared for a seasonality sideways chop, they call it. And hold on. All right. So let's go back to our chart here. Okay. So going back to the S&P, we're above all the moving averages, which is very positive for continuing uptrend. We're halfway between overbought and oversold. Um, and let's look at our talking points for this week. Okay, so we're approaching August right now. August is a subpar month, usually not that great. Going into September, and that's usually a worse month. So you got to be ready for that. We're basically out of earnings season right now. We have most of S&P report in July, and there's only a couple companies reporting in August. One of the biggest ones is NVIDIA at the end of the month. So, um, so we basically have government reports in August. So it's kind of that could be why we have a sideways summer months. Um, okay, so let's look at some of the earnings releases for this week. We had Berkshire Hathaway report on last Saturday, and they had subpar um, report, and their stock went down a little bit. We have Novo Nordisk. They had a bad report. We had Walt Disney and Eli Lilly. They had better than expected earnings, but one of their drugs um, for weight loss pill did not perform as expected. So the stock went down a lot based on that. And we'll go over that a little bit later on. And this week, you can see that a lot of these companies are smaller companies. We have Cisco, and another interesting AI play is CoreWeave, and we have Circle, a recent IPO. Those are the only interesting ones to me in this coming week. So we'll watch out for that. It used to be Cisco was a market leader, and it's whatever it said was very important to the whole market, but it's becoming less important. All right, let's look at the numbers from last week. The S&P is up around 2% from last week, considering it's up a little bit today. Um, and we have around 55% of the S&P stocks above the 200-day moving average. And that's like a neutral momentum right now. We have the Fed scheduled to reduce interest rates many times this year. We have the stock market, it's basically not overbought, not oversold. It's like halfway. And we have the treasuries up 1% this week. So that's going to put a lot of pressure on companies that need to borrow money. All right, so let's look at other. Okay, we already talked about we're going into two of the subpar months of the year in the S&P seasonality wise, and we're going to have more volatility. So get ready for volatility because during August, September, and peaking in October, we have heightened volatility, meaning it could go down and up a lot. All right, and we already mentioned we're approaching a time where traditionally we've been sideways. So don't be surprised if the S&P and the whole market kind of goes up and down until around November. All right, so I drew well, we had a couple breaks in trend here. So we've been tracing the higher lows and the higher highs since the April low. And we kind of broke this trend with the blue lines there. Then we basically, I guess the one good thing is we're still following this 20-day exponential moving average. It seems like we're going into a more complicated phase in the S&P where we're going sideways. So as far as we can't really use this at all right now in determining buy points for stocks that we're trying to dollar cost into. It's just something we have to keep in mind. It's going to be a little bit choppy right now for the next couple of months. All right, so let's look at the U.S. 10-year Treasury yield. Um, it was a 1-to-1 correlation this week. That's very interesting because usually there's a inverse correlation. As the U.S. Treasury goes up, the stock market usually goes down. But basically, when the U.S. Treasury went up 1% this week, the stock market went up also. So I'm not sure why there's that dichotomy, but that's what happened this week. Okay, the price of oil is going down a little bit this week. So um, last week we had a job report showing that the economy is slowing. So it very well may be that the economies around the world are slowing also. And we have lower oil prices whenever the economies around the world are slowing. Okay. And the inflation is up just a little bit since from last week. It was 2.67 last week. Now it's 2.7. It seems like tariffs are starting to take effect on inflation. The dollar index is up 1% since last week. And we still have a downward trend in the US dollar. And let's see, the fear greed index, we're at neutral. It was at greed last week, and we're going back to neutral. So there's no action to take. I mean, when we have extreme greed in the stock market, it's time to take some profits off the table or don't buy. When it's extreme fear, it's time to hold your nose and buy or don't sell. But right now, we're kind of in the middle. And that kind of corresponds to our um, sideways chop for the summertime. All right. So this is interesting. The AAII sentiment survey shows majority of market participants that are amateur are bearish. So that's a contrary indicator. When the average investor is bearish, it's time to buy or don't sell. So we have a couple indicators that are different this time. So let's just keep that in mind. The VIX the VIX is relatively low. Um, that means there's not a whole lot of fear in the market. We have in our emotional graph of investor mindset, we're at a denial stage right now. We just had a good uptrend in the stock market. Let's look at this again. Okay. Okay, we had a nice uptrend. Now we're kind of peaking, going sideways. And if we look at our graph, it seems like we're in a denial stage right now. And for the next couple months, we're going to be kind of in this sideways denial, return to normal, denial, return to normal. If we have an exogenous event, um, we could have like a little capitulation here in the summertime or in September, but we just have to be ready for that. Um, all right. So the only thing that's the intangible variable that we're watching is tariffs. We don't know how that's going to affect the companies that tariffs are put on, and we don't know what's going to happen or come out of the president's mouth. So that's going to be something that affects the stock market every day. Okay, so um, here's a chart. We're basically at a PE around 27 right now in the S&P 500. And you can see through the history since the 1800s, we've we've gone between an extreme of 5 PE to 27. We're basically at the highest we've ever been averaged in the history of the stock market. And that corresponds to some of the peaks you can see in the dot-com bubble. And we have a couple other peak times before the year 1920 crash. And we have, something, but we do have better earnings now than we had during the dot-com bubble. We have um, very strong companies that are leading the stock market. So it's a little bit different now. But the big picture here is that we are overextended and, and overbought in a lot of part of the stock market. So it seems like right now we have to we have to look at PEG ratio. We have to look at, if we look at our screen for this week, you can see the PEG ratio for a lot of the big stocks we're watching are over one. That's a good indication that we're priced to perfection and that we're paying more for the stock than it's worth. So I like to buy stocks when they're at a PEG ratio of one or lower, because that means you have at least you're buying it at fair value. Warren Buffett would rather buy a great company at a decent price than a um, horrible company at a great price. So let's keep that in mind while you're investing. All right, so look at our first to worst from this year. Seems like communication services and IT are starting to outperform. We have industrials and utilities also doing really well as the top performers for this year. And the ones doing the worst, healthcare, continues to do poorly, and energy is negative 1.5%. Consumer discretionary is also bad. So it seems like the healthcare can't get a bid right now. It has some of the lowest valuations in the stock market. And I'll show you a little article later on where there are some people that are starting to think that some of the sectors that aren't in favor right now could be ones to start looking into. Okay, so this is the PE valuations relative to history. You can see that energy, healthcare, financials, real estate are all below their percentile rank in history. So that these are the ones at least that are most under what they usually trade for. The ones IT, consumer discretionary, industrials are trading at a higher percentile, meaning they're overvalued right now. So um, keep that in mind whenever you invest, because I tend to like to buy stocks that are out of favor, and sometimes we have to really look for quality stocks that are out of favor because they're out of favor for a reason, usually. But let's look at our some of the stocks going up and down today. We have market movers. Okay. We have for the S&P, the ones going up and down the most, we have Tesla's going up a lot. We have Micron, we have Dell, HPE. We have we have a lot of stocks involved with the AI build out, the AI infrastructure. We have Tesla, they're like classified as an AI company a little bit. HPE, Hewlett Packard make servers for data centers. Dell Technology, the same. Um, Tesla does a lot of AI. We have Micron Technology. They make memory for the AI build out. And all right, that's all I can see. The one's doing the worst. Trade Desk. Wow, that is a lot. They're a company that does advertising similar to Google and Facebook, but they do it for a certain, I think they do it for like a TV, something like Netflix. They might allow for advertising on mediums like that. They're down a lot. Wow. GoDaddy is down 7.1%. What things do these have in common? We have a lot of data build out stocks going down too. We have see Datadog, they do software for the cloud. We have Edison International. They've been up a lot based on the demand for energy in data centers. Supermicro, they make the servers for the data centers. So we have the best of it's like the tale of two cities for AI. Let's look at the NASDAQ. Okay, here's Alphabet. We talked a little bit last week or week before. Whenever a stock gets to 190, it goes to 200 real quick. Same thing with stocks that are at 90. When stocks are at 90, they go to 100. I don't know why. That's just the way the market works sometimes. So now Google's at 100, at 200. Let's look at all right. Okay, that's all I can get from that. Sectors. Let's look before we go to the sectors. Let's look at our U.S. Treasury. It's been going up this week, so it's up like 1.5%. So let's look at the S. So as the treasuries are going up, that makes real estate less expensive. So you can't, I mean, more expensive. So people can't afford mortgages if you raise the rates too high, and that reduces the demand for real estate. That's probably why the real estate is down the most today. Um, Utilities, well, why would they be? Well, they're kind of neutral right now. Home construction. All right. Okay. So the rising rates today totally affected the real estate ETFs. The ones going up the most are mining, telecom, regional banks. Okay. So there was a story that the president is tariffing gold from Switzerland, gold bars made from Switzerland. So that's totally affecting the gold market. And we were talking last week about gold. Um, let's look at gold. Okay, I missed that. We'll go over it later. But Gold is actually catching a bid this week. It was out of favor last week. Let's look at gold. So, so gold it's down a little bit today. Okay, gold last week it was down here at the 200-day moving average and it was out of favor. Now it's actually to a point where it's getting to be overbought again. Okay, so let's look at some more of our talking points. Okay, Dan Now's best picks for this year. Cisco is up 18%. That's his best pick. We have KBWB, the banking ETF worth large banks such as JP Morgan and Bank of America. And ADTN, another networking play for the AI infrastructure build-outs, up 5%. Okay, so his picks are doing pretty good. I picked out some charts of interest. Last week, we were talking about how Netflix had almost a perfect setup. It was oversold and at the bottom part of its upward channel. So so it seems like Netflix had great earnings. It's overvalued right now, actually. Um, it's it's about, let's look at a quick valuation, do a quick valuation of Netflix. So Netflix is like 2 times, it's grown at like 20%, and its forward PE is 46. So that is 2 times its growth rate. So it could easily correct going, if there's a bad report on Netflix, it could easily go down like a lot. But it has had momentum and it's in an uptrend. And it also can be considered defensive in a market that's choppy or if we have fears about the economy. Because if the economy is slowing, people aren't going to give up a $20 entertainment for a whole month. So this might be one of the last things people give up. But you can see that we're super oversold. Look how much we're oversold in every one of these indicators as of last week. That could be why it's going up a little bit today. Okay, let's look at some more of our interesting. Okay, this is gold. Um, you can see that it went up. Let me see. You can see that gold is kind of at the bottom end of its channel. It's kind of a little bit oversold. That was last week. Last week we had that perfect setup, and this week, it went up, like 1 or 2% since last week. Let's look at another chart. We have a healthcare sector. You can see it's been in this downtrend, but we're kind of starting a sideways movement for this kind of corresponds to our summer sideways for the next 2 months. But this is a sector that's totally out of favor right now. And it's really hard to buy stocks in this sector because yet the sector has a lot of headwinds. Like right now, they have the president saying that there's tariffs. There's like 250% tariffs on imported drugs, and they're making drug makers match what other countries are paying. So I mean, they're making drug makers have traditionally sold medicine for less of a cost overseas than in America. So the president said that we have to make the prices the same. So that could really affect the price people are willing to pay for drug stocks. So those two overhangs are really causing this negative momentum in the stocks of these healthcare. So it's really hard to invest in this right now. Um, the real estate ETF, you can see that we're kind of oversold right now. We've been in a sideways pattern for over a year. So it looks like um, with the interest rates, it doesn't seem like they have gone anywhere. That's really hurt the real estate ETF. Let's look at the home construction ETF. We highlighted this last week as a potential um, reversal. You can see that we broke through this downtrend right here, and we're starting a new uptrend. And as the Fed reduces interest rates, as interest rates come down, that was one of the first things that the administration wanted was lower interest rates. So as the interest rates go down, demand for housing will go up. So let's watch this home builder ETF. Um, and this is where we went through Netflix. Let's look at Visa. This is an example. Visa is totally out of favor right now. It's oversold. You can see that it's been kind of like a sideways pattern for almost a year. And we're kind of nearing like the bottom part of this uptrend right here. We're at the bottom. This is very similar to Netflix from last week. We're oversold and at the bottom of its range. Um, so I'm thinking by the end of this year, we're going to have Visa towards the top of this range. Let's see if this stock holds right there. All right. So you can see the most important thing for the stock screen for this week is the PEG ratio for a lot of the stocks we're following. They all seem to be PEG ratio is over 1, meaning they're mostly trading above their growth rate. So that means that stocks are trading for a premium right now. And you have to be willing to hold stocks as they go down to their fair value, which is a PEG ratio of around 1. So I didn't see anything interesting in our stock screen this week. Okay, so here's a note from a guy from Morgan Stanley, Chief Equity Strategist, Mike Wilson. He said basically there are some sectors that are out of favor right now, such as housing, commodities, consumer goods, and small caps. Okay, so what Mike Wilson is saying is basically start looking at some of the laggards for this year and as possible sectors that will do better from now until the end of the year. So housing, commodities, consumer goods, and small caps. I guess of this list, small caps is probably the most interesting because interest rates are supposed to be going down, and that's going to help companies that need to borrow money, like the small caps. And as interest rates go down, that could help the housing sector and the commodity sector. Um, all right. Okay. Here's a story from Yahoo Finance. Jim Cramer says that MasterCard has very strong fundamentals. Um, Mastercard is up 8.6% year to date. The shares have recently struggled because of the fear from stable coins, possibly. And I mentioned whenever that story came out that um, there's so many people that are used to spending with a credit card. It's going to be real hard people to switch to a stable coin or um, cyber currency because people get rebates. They get 1% back. They have a good way to track their finances. It's easy to take a credit card out and spend it. Um, it's going to be really hard to switch the world from Visa, MasterCard, American Express to cryptocurrency. But it could happen. That's kind of why they're kind of not trading as well, in recently. Um, So basically, Kramer was saying he likes American Express better than Visa or MasterCard, primarily because Visa and MasterCard, they've always traded at a premium. They're trading at double what their growth rate is, and American Express is a little better valuation. Also, American Express has a younger demographic, and their users spend more. They actually have more money. So those are all good things. The one bad thing about American Express is it takes on some of the liabilities when people default. Whereas Visa and MasterCard, they're a toll road. They don't have any liabilities when the consumer doesn't pay their credit card bills. That's the bank's issue. All right, so let's look at MasterCard. You can see it's in an uptrend. Has been in an uptrend for several years, 10 years. And you can see that it's growing around 10% a year, 10 to 15%. It's halfway between its overbought and oversold, and its trend line, it's about halfway between I mean, it's top of the trend line and the bottom of the trend line. Um, so it's not really a good time to buy it. It's like a halfway between buy and sell. You can see the forward PE is 34 and and the PEG ratio, according to Yahoo Finance, is 2. So it's around 2 times overvalued. The profit margin is off the charts 4 times better than we're looking for at 44. And return on equity is 176. That is 10 times better than we're looking for. Um, Total cash, they have 9 billion in debt, which isn't a lot compared to their $500 billion market cap. So it's a very profitable company. Just think they have servers and customer service reps. It's kind of their main costs. And and let's see, MasterCard estimates for this next year and the year after around 16% growth. So the P ratio is 34. They're growing at 16. Um, and their PEG ratio then is 2. So they're 2 times overvalued, but they've been 2 times overvalued for 10 years. So it's going to be real hard to get this stock on sale unless there's a major problem. So this is an example of you pay more for a stock, you pay more for a car that starts in the morning. So it's a quality stock and it sells at a premium, but it always does. It's very similar to Netflix. It's always selling at a premium. Okay, let's look at some of the estimates on MasterCard. We see from Morningstar, they think the price is 12% overvalued. So that's not that bad. And they said the revenue's grown around 16% year over year. That matches our numbers, roughly in line with what the company has done for the past couple of quarters. Okay, so they're they're growing around 16% a year. And they have a monopoly, a duopoly with Visa, kind of. And let's look at CFRA. They say it's a buy with the price target of 720. And their opinion, MasterCard is innovating rapidly, and we expect the payment network to gain share while margins approach larger peer Visa. Growth verticals include cash, check to card transaction, and commercial payments. A catalyst could come from China as MasterCard received formal approval from joint venture to process domestic transactions. Wow, that's pretty big. Value-added services gain momentum with security solutions driving outsized growth. Tokenization is an exciting driver with over 1/3 of transactions tokenized, reducing fraud and increasing approval rates. Okay, so they're a very innovative company and they're continuing to go into different areas. They actually are getting into stable coins and a couple other hot topics. Um, you can see that their fair value, according to CFRA, is 535, which is a little overvalued by 4%. So that's not that bad. Um, Free cash flow, you can see it's growing in a straight line. This is like a perfect growth stock right here. Earnings growing every year around 10%. Look at that, 15%. And the same thing with revenue is growing in a straight line. That's all what we want to see. One of the best things here is the return on equity gets better by 10% every year. That's pretty amazing for a company to be more efficient every year. Um, Here's another story. I like payment process. Um, they're like a toll road. They're once you have your infrastructure in place, a bit of every transaction. Block is a company that does um, their payment processor company. There's a news story that says they gain after strong profit growth despite EPS myth. So they missed their earnings this week, but they guided better. So a lot of times the guidance is more important than the actual profit. So they're growing around 21%. Their profit margin is decent. At our minimum at 14 and 12. Um, the PE ratio is 23. They're growing at 23. Their PEG ratio is around 1. So they're about fairly valued. Here's a story that came out. Eli Lilly second quarter earnings beat on strong GLP-1 sales, but stock market dives on GLP-1 pill trials. So they reported better than expected earnings and they guided really well. Usually that combination makes the stock go up, but the stock went down something like 14% because their current GLP-1 pill disappointed in late stage trials. So the two things that were bad about that report was the company reported a 25% patient dropout rate. Um, there's a note that said the discontinuation rate on the placebo was also high at 29%. So there must have been something wrong with their study where people were dropping off of this medicine in the placebo and in the regular. So they might have to do, and there's other studies that are coming out that might help. So that could have been a faulty study. Um, but only 11% weight loss in this study versus Wegovy tablet, which is 16% weight loss. So that was the biggest thing right there. Um, there's not a lot of people that like taking um, needle injections. And if there's an alternative to that with the same efficacy, people will take that. So um, the market is worried that the market might move from this GLP-1 injections to a tablet format. And if Wegovy takes over that, then Eli Lilly won't have all this growth anymore. So that's what to wait for other studies to come out. So their forward PE right now is 29, and their PEG ratio is 9.98. So they're basically fairly valued right now. If we look at a growth rate, their growth from this year to next year is 36%. So their PE ratio is 29, growing at 36. So their PEG ratio is 0.79, maybe 20% undervalued right now. So that's interesting because it's been overvalued for the last 2 years. Um, so let's watch that stock. Um, right. So that is okay. That is what I had to say for this week. I hope you enjoyed that talk, and I hope you have a good investing week going forward. And I'll see you next time.